Let's bring back our FOMC roundtable. Diane Swonk, chief economist at Mesirow Financial. She's in Chicago. Nigel Gault, chief U.S. economist for IHS Global Insight, and he is in Lexington, Massachusetts. Thanks for staying through that. Diane, let's start with you. The Fed action today is going to keep borrowing rates down, but is it enough to keep this economy from relapsing back into recession?
Well, clearly that's what they're concerned about. It's also, I think, it's interesting, the double twist. As Mike pointed out, although mortgage rates have come down, they've not come down as rapidly as the 10-year Treasury market has. And also the move out further to 30 years, something that Larry Meyer had actually talked about, former Fed governor, that they would likely do that and do a mix of mortgage-backed securities. He thought that was the best fix for them to have an actual influence on the economy. I also think it's interesting that the dissents, although there were 3 of them, there was not a lot of explanation in the statement for the dissents, and I think that's very important given the political backdrop. This was a bit of a raspberry to both the Democrats and Republicans, saying, the Fed's going to do what it's going to do. We dissent internally. We have our job to do, and we're doing it regardless which side of the aisle you're on and which side is attacking us. We just did what we wanted to, and you guys just got to live with it.
Nigel Gault, was the Fed's action a little bit more aggressive than you were expecting?
A little bit more. I mean, the twist is probably roughly in the range that I'd be looking for. We have this interesting wrinkle of reinvesting mortgage-backed securities, trying to reduce the gap between the mortgage interest rate and the government yields. It's a good idea. I don't think it has a huge impact, but it's worth trying. I think that probably overall what was done on the twist side is going to be fairly similar to what the market was anticipating. And stocks, of course, have reacted to the statement about significant downside risks. And we also have to bear in mind that, of course, the bond market will be reacting to exactly the same thing. So any rally we've got in the bond market is going to be a combination of the twist, but put that alongside the significant downside risk stated by the Fed, which has hurt the stock market. If the Fed says that, that's an indication that it's very concerned about the future.
And Diane Swonk, as Sheila Dharmarajan was just telling us, markets didn't seem to be reacting too favorably to this.
Oh, I'm sorry. I thought you were talking to Nigel. I was just going to point out, yeah, I think Nigel's right. They're reacting to the downside risk, which is the reality we're living in. But it is consistent, right? That the economy is weak, the bond market would rally, and the equity markets would not initially, until they see the whites of the eyes of a stronger recovery out there, actually try to rebound. I do also think it's very important, the issue of, the 30 years moving out further than many people had expected. That will help to discourage even more people staying in the safety of the Treasury market and could get them to make longer-term bets in the equity market and in other markets. I also think it's important that the Fed noted the European situation and the global stress on financial markets today. That is clearly where the risk lies, and the Fed is now acknowledging that, and it's in concert, I think we're going to see, with G20 meetings and other ECB communications going forward.
Nigel Gault, if I might ask you quickly, low interest rates, they haven't helped housing since 1982. Those low rates have aided every recovery except the current one. Will even lower rates help in any meaningful way at all?
I don't think so, not in a meaningful way. It helps a little bit at the margin. But the problem is people's access to credit is very limited. Even if the low interest rate's there, you maybe can't take advantage of it. And also the simple fact that we have this huge oversupply of housing that we put in place during the boom. We're trying to work that off, and it's taking years to do it. So interest rates help at the margin, but they don't change things. No, not game changers.
Again, Diane, I'll give you about 15 seconds. Last comment.
Well, I agree on the issue on the mortgage situation in particular. That is actually going to be tightening as we go forward, not easing up. And so consumers, it's very telling. Today's increase in home sales was due to investors in cash purchases, not a lot of mortgage availability.
Diane Swonk, chief economist, Mesirow Financial from Chicago. Nigel Gault, chief U.S. economist, IHS Global Insight from Lexington, Massachusetts. Thank you both so much. Appreciate your time today.
Thank you.